Welcome back, aspiring investors. Today, we're diving into the mind of the Warren Buffett. With a net worth that places him among the richest individuals on the planet, Buffett's investment strategies have been studied and admired by millions. But what if we told you that the core of his success boils down to just 3 fundamental rules? In this video, we'll unravel these timeless principles that have guided Buffett to build an empire. Whether you're a seasoned investor or just starting out, these rules are the bedrock of smart investing. Warren Buffett started investing when he was 11. Before that, he dithered away his time until he was 7 or 8, and again at 9, but didn't get serious until 11. At that age, he bought his first stock and began experimenting with various strategies like timing stocks and charting. It was a lot of fun, though ultimately profitless, and he continued this way until he was 19. He devoured every investment book in the public library. The subject fascinated him, though he had no real framework and was searching for something concrete. He hoped the charts would reveal stock movements, which was a bit crazy, but since everyone else was doing it, he followed suit. Sometimes he'd even turn the chart upside down, but it still didn't help. In 1949, he read The Intelligent Investor by Ben Graham. Before then, he hadn't heard of him. Only 2 chapters in that book truly matter, yet they formed Buffett's philosophical framework for investing in 3 essential ways. They are so basic and simple, yet profoundly important, akin to the 10 Commandments. Firstly, a stock is part of a business. One must value a business and then divide by the shares outstanding. It's crucial to consider what kind of business is being invested in, its economic characteristics, competitors, and management. At 11 or 12, Buffett knew the ticker symbols of nearly every company on the New York Stock Exchange, but he didn't understand the businesses behind them. He had to start viewing these symbols as businesses to evaluate their true value. Warren Buffett devoured every book on investing in the public library, finding the subject utterly fascinating. However, he lacked a proper framework and was simply searching for something, hoping that small details on a chart would reveal stock movements. At 12, Buffett knew the ticker symbols of nearly every company on the New York Stock Exchange. He could even mark the boards at Harris Upham, identifying symbols like X for U.S. Steel and T for AT&T. Despite this, he didn't truly understand what was behind these symbols. He had to start viewing these little names in the paper as businesses and figure out how to value them. The second crucial concept from the book The Intelligent Investor by Ben Graham is how an investor should react to stock market fluctuations. Graham introduces the idea of the mythical Meister market in Chapter 8, which profoundly shapes an investor's attitude towards stock prices. Most people react the wrong way, feeling good when their stocks go up and bad when they go down, as if the stock market is there to instruct them. Mr. Market, as Graham describes, is like a partner in investing who comes around every day to tell you what he'll pay for your interest in the business or what he'll sell you more for at the same price. No one in private business behaves like this. If 2 people owned a gas station together and one demanded daily buy-sell offers, it would create a disadvantage. Mr. Market does this with stock prices, presenting different figures at the beginning and end of each day. He is unsound, an alcoholic manic depressive, and he names all kinds of crazy prices. Investors don't have to pay attention to him unless it benefits them. It could be once a year or once every 5 years when a stock out of 3,000 is particularly mispriced. Investors have no moral responsibility to Mr. Market. They only need to take advantage when he is particularly depressed, manic, or drunk. This concept is remarkable in the stock market. The high and low prices of American companies can vary widely within a year, unlike other assets like farmland or apartment houses, which don't experience such drastic changes. This fluctuation in stock prices allows investors to only engage when it's advantageous for them. A key lesson from Graham. The market isn't there to instruct you or tell you anything. Instead, it exists to serve you when you want it to serve you. This is a crucial point to remember, though it's hard to do because people often have emotional responses to stocks. A stock doesn't know you own it. It's just a part of a business. If you hold shares of Berkshire Hathaway, the company itself doesn't know or care that you own its stock. It's trading, but it has no feelings about you. Your feelings don't affect the business's value. If Berkshire is worth around $110 billion, it's a good investment. If not, it's a lousy one. You have to evaluate the business itself, which is what Graham emphasized. It's remarkable, but on Wall Street, people often don't do this. Instead, they focus on price targets and similar metrics. Rarely does anyone write a detailed analysis of a business's nature and potential over the next 20 years, determining what it should sell for, ignoring its current selling price. When looking at investments, Buffett prefers to analyze them without knowing the price. Seeing Seeing the price can automatically influence your judgment. Instead, he studies reports like 10Ks without checking the stock price first, allowing for an unbiased valuation. Buffett compares this to how he used to handicap horses as a kid. He would get the racing form in advance and evaluate each horse's chances of winning without looking at the odds. With 9 horses in a race, the probabilities of winning had to add up to 100%. He would calculate each horse's chances and then compare those probabilities to the odds, rather than being influenced by the odds initially. The stock market should be approached similarly. When Warren Buffett compares probabilities to odds in horse racing, he doesn't immediately glance at the odds. Instead, he meticulously studies the horse's past performances and their track records. This same methodical approach defines his strategy in the stock market. Rather than being swayed by daily fluctuations in stock prices, Buffett first delves deep into understanding the fundamentals of the businesses he considers investing in. The third principle from Benjamin Graham's book, The Intelligent Investor, emphasizes the concept of the margin of safety. Buffett illustrates this with a practical analogy. Imagine approaching a bridge with a sign indicating its capacity is 10,000 pounds. If you're driving a truck weighing 9,800 pounds, would you risk crossing it? Most likely not. Similarly, in investing, Buffett advises always leaving a margin of safety. This means not stretching investments to their limits, but waiting for clear opportunities that offer a significant margin of safety in the stock market. These 3 fundamental principles, business valuation, rational behavior towards market fluctuations, and maintaining a margin of safety, form the cornerstone of Buffett's investment philosophy. Each principle acts like a leg of a sturdy stool. Removing any one weakens the structure. Buffett places paramount importance on understanding the businesses he invests in. Imagine you have a substantial amount of capital and a week to invest in any 3 businesses across Tennessee. How would you proceed? Buffett suggests thoroughly researching companies with enduring competitive advantages. This doesn't just mean picking the current top performer, but identifying businesses with sustainable moats that protect them from competition. These advantages might stem from prime locations or strong brand recognition, similar to Coca-Cola's global presence and positive consumer perception. Equally crucial for Buffett is investing in businesses run by capable and honest management. He often jokes that the best businesses are those that can thrive even with mediocre management. Peter Lynch's advice resonates here. Buy a business that's so good that even an idiot can run it, because sooner or later, one will. Once you've identified businesses with enduring competitive advantages and competent leadership, the next step is to ensure you're paying a sensible price. Buffett prefers evaluating businesses without knowing their current market price initially. This approach allows him to focus solely on the intrinsic value and long-term prospects of the business, without the distraction of short-term market fluctuations. Buffett's strategy mirrors the strategic thinking of chess grandmasters. Just as they sift through billions of possible moves to focus on a few critical ones, Buffett filters through thousands of potential investments to find a handful of promising opportunities. He suggests that rather than trying to pick the best-performing stocks, it's often more effective to eliminate the weakest options first and then concentrate on the remaining strong contenders. In conclusion, Buffett advises investors to approach the stock market with patience and discipline. Even if you find just a handful of exceptional investment opportunities in your lifetime, these can significantly impact your financial success. This disciplined approach, focused on understanding businesses, maintaining a margin of safety, and investing in strong, honest management, has been the cornerstone of Buffett's legendary success in the world of investing. Remember this: successful investing hinges on understanding businesses deep, staying resilient in the face of market volatility, and always ensuring a margin of safety. Whether you're new to investing or refining your strategy, these principles provide a solid foundation. By focusing on business fundamentals rather than fleeting market trends, by remaining calm when others panic, and by insisting on a margin of safety with every investment, you can build a resilient portfolio. So the next time you review a stock or contemplate a new investment opportunity, think like Warren Buffett. Invest in what you know, wait patiently for the right moment, and think long-term. If you found this video insightful, don't forget to hit the subscribe button below for more valuable insights on investing and finance. Thank you for joining us on this journey through Buffett's wisdom. Here's to your future success in investing.